Do you want to successfully complete the C214 Objective Assessment exam? Then you are in the right place. Our website provides a list of questions and answers for your success in the C214 OA exam for free. We understand that acing your OA exam can be quite challenging. That's why we provide completely free exam guides and practice questions for you. In this video, we will cover questions from corporate finance, investment and risk analysis, financial statements, bond markets, and regulatory framework. So let's get started. 1. Which of the following represents a way to manage working capital effectively? A. Collect slowly and pay quickly. B. Collect quickly and pay quickly. C. Collect quickly and pay slowly. D. Collect slowly and pay slowly. What do you think is the answer? Correct answer, C. Collect quickly and pay slowly. Explanation. Option C is correct because working capital is the money a business uses for its everyday operations. To manage it well, a business wants to get the money it is owed from customers as fast as possible, but take a little longer to pay its own bills while still paying on time. This approach maximizes the cash on hand. Option A is incorrect because collecting slowly and paying quickly is the worst-case scenario for cash management, as it minimizes the cash available to the business. Option B is incorrect because while collecting quickly is good, paying quickly reduces available cash that could be used for other short-term needs or investments. Option D is incorrect because collecting slowly is detrimental to cash flow. While paying slowly helps preserve cash, the slow collection negates the benefit, leading to poor working capital management. 2. Which financial statement area would show investments in long-term assets? A. Operating activities. B. Investing activities. C. Financing activities. D. Balance sheet. Do you know the answer? Correct answer, B. Investing activities. Explanation. Option B is correct because on the statement of cash flows, the investing activities section reports cash spent or received from buying or selling long-term assets. These are items the company plans to use for more than a year, like buildings, machinery, or equipment. Option A is incorrect because operating activities relate to the cash flows generated from a company's normal day-to-day business operations. Option C is incorrect because financing activities report cash flows related to debt, equity, and dividends, such as issuing stock or repaying a loan. Option D is incorrect because the balance sheet lists a company's assets at a single point in time, but the cash flow activity from buying or selling them is shown in the investing activities section of the cash flow statement. 3. What type of bond is typically exempt from federal taxes? A. Treasury bonds. B. Corporate bonds. C. Municipal bonds. D. Junk bonds. What do you think is the answer? Correct answer, C. Municipal bonds. Explanation. Option C is correct because municipal bonds, often called munis, are issued by state and local governments to fund public projects. A key feature is that the interest income investors earn is usually free from federal income tax, making them attractive to certain investors. Option A is incorrect because treasury bonds are issued by the federal government, and their interest income is taxable at the federal level but typically exempt from state and local taxes. Option B is incorrect because corporate bonds are issued by companies, and the interest income earned from them is fully taxable. Option D is incorrect because junk bonds are high-yield, high-risk corporate bonds, and their interest income is fully taxable. 4. What does the term collection float refer to? A. The time it takes for inventory to be sold. B. The delay between paying suppliers and receiving payment from customers. C. The time it takes for a firm to use the payments from customers. D. The gap between short-term and long-term liabilities. Do you know the answer? Correct answer, C. The time it takes for a firm to use the payments from customers. Explanation. Option C is correct, because collection float is the time lag between when a customer pays a company and when that company can actually access and use the money. This includes time for the payment to be mailed, processed by the company, and cleared by the bank. Option A is incorrect because the time it takes for inventory to be sold is measured by inventory turnover, or days of inventory on hand. Option B is incorrect because the delay between paying suppliers and receiving payment from customers describes the cash conversion cycle. Option D is incorrect because the gap between short-term and long-term liabilities relates to a company's debt maturity profile, not to payment processing time. 5. What does a positive free cash flow represent for a company? A. A need to raise more capital. B. Cash available to pay down debt or distribute to shareholders. C. A loss of profitability. D. Cash tied up in working capital. What do you think is the answer? Correct answer. B. Cash available to pay down debt or distribute to shareholders. Explanation. Option B is correct because positive free cash flow is the cash a company has left over after paying for its operating expenses and long-term asset investments. This extra cash is available for strategic uses like paying off debt, giving dividends to shareholders, or making new investments. Option A is incorrect because a positive free cash flow signifies financial strength and less need, not more, to raise external capital. Option C is incorrect because positive free cash flow is a strong indicator of financial health and operational profitability, not a loss. Option D is incorrect because free cash flow is the cash remaining after changes in working capital have already been accounted for. 6. Which of the following financial measures represents a firm's short-term liquidity? A. Return on assets. B. Debt-to-equity ratio. C. Quick ratio. D. Earnings per share. Can you guess the answer? Correct answer, C. Quick ratio. Explanation. Option C is correct because the quick ratio, also known as the acid test ratio, measures a company's ability to pay its short-term liabilities without relying on the sale of inventory. It compares the most liquid assets to current liabilities. Option A is incorrect because return on assets is a profitability ratio that measures how efficiently a company is using its assets to generate earnings. Option B is incorrect because the debt-to-equity ratio is a leverage ratio that measures how much debt a company uses to finance its assets relative to its equity. Option D is incorrect because earnings per share is a profitability ratio that indicates how much profit a company makes for each share of its stock. 7. What does the term terminal cash flow refer to in capital budgeting? A. The first cash inflow from a project. B. The last cash flow generated by the sale of an asset. C. The total cost of starting a project. D. The total profits expected from a project. Do you know the answer? Correct answer. B. The last cash flow generated by the sale of an asset. Explanation. Option B is correct because in capital budgeting, The terminal cash flow is the net cash flow that occurs at the very end of a project's life. This includes the after-tax proceeds from selling the project's assets and any recovery of working capital. Option A is incorrect because the first cash inflow is part of the project's operating cash flows, not its terminal cash flow. Option C is incorrect because the total cost of starting a project is known as the initial investment or initial outlay. Option D is incorrect because the total profits expected from a project are measured by metrics like net present value or internal rate of return, not terminal cash flow. 8. What is the impact of increasing a company's degree of financial leverage? A. Decreased risk. B. Increased risk and profitability. C. Decreased debt levels. D. Higher cash flow volatility. Can you guess the answer? Correct answer, B. Increased risk and profitability. Explanation. Option B is correct because financial leverage involves using borrowed money to finance assets. Increasing leverage can magnify profitability for shareholders if the company earns more on the assets than the cost of debt. However, it also increases financial risk because the company must make fixed debt payments regardless of its earnings. Option A is incorrect because taking on more debt increases a company's financial risk, as it raises the obligation to make interest payments. Option C is incorrect because increasing financial leverage means increasing debt levels, not decreasing them. Option D is incorrect because while higher cash flow volatility is a consequence of increased risk, option B is a better answer as it captures both the potential upside and downside. 9. What does the sustainable growth rate indicate for a company? A. The growth rate supported by external funding. B. The growth rate achievable without external funding. C. The dividend growth rate. D. The inflation-adjusted growth rate. What do you think is the answer? Correct answer, B. The growth rate achievable without external funding. Explanation. Option B is correct because the sustainable growth rate is the maximum rate at which a company can grow its sales and assets without issuing new equity or changing its debt-to-equity ratio. It is the growth a company can support by reinvesting its own profits. Option A is incorrect because the sustainable growth rate specifically measures the growth achievable without new external equity financing. Option C is incorrect because the dividend growth rate is a separate metric that measures the annual growth in a company's dividends per share. Option D is incorrect because the inflation-adjusted growth rate, or real growth rate, is the rate of growth after accounting for inflation, which is a different concept. 10. Which of the following represents discretionary accounts in corporate finance? A. Accounts that vary with sales. B. Accounts that change by management decision. C. Accounts that are automatically adjusted. D. Accounts that reflect cash flow from operations. Do you know the answer? Correct answer, B. Accounts that change by management decision. Explanation. Option B is correct because discretionary accounts are balance sheet or income statement items whose levels result from deliberate choices by management, rather than changing automatically with sales. Examples include long-term debt, new stock issuances, and fixed asset investments. Option A is incorrect because accounts that vary directly with sales, like inventory or accounts payable, are known as spontaneous accounts. Option C is incorrect because accounts that are automatically adjusted with sales levels are spontaneous accounts the opposite of discretionary accounts. Option D is incorrect because cash flow from operations is a category on the statement of cash flows, not a type of account classified as discretionary or spontaneous. 11. What is the primary reason companies issue debt instead of new equity to raise capital? A. Lower administrative costs. B. Interest tax benefits. C. Easier to manage. D. Higher returns for shareholders. What do you think is the answer? Correct answer, B. Interest tax benefits. Explanation. Option B is correct because the interest a company pays on its debt is a tax-deductible expense. This reduces the company's taxable income and lowers its overall tax bill, creating a tax shield. Dividends paid to shareholders from issuing equity do not offer this tax advantage. Option A is incorrect because issuing debt can involve significant administrative and legal costs, and this is not the primary benefit. Option C is incorrect because managing debt covenants and payment schedules can be complex and is not necessarily easier than managing equity. Option D is incorrect because while using debt effectively can lead to higher returns for shareholders, the direct financial reason for preferring debt is the tax deductibility of interest. 12. What is the coupon rate for a bond? A. The interest rate offered by the company on the bond. B. The price paid to purchase the bond. C. The face value of the bond. D. The yield to maturity of the bond. Can you guess the answer? Correct answer, A. The interest rate offered by the company on the bond. Explanation. Option A is correct, because the coupon rate is the fixed annual interest rate that a bond issuer promises to pay to the bondholders. It is expressed as a percentage of the bond's face value and determines the amount of the periodic interest payments. Option B is incorrect because the price paid to purchase the bond is its market price, which can fluctuate and differ from its face value. Option C is incorrect because the face value, or par value, is the principal amount that is repaid to the bondholder at maturity. Option D is incorrect because the yield to maturity is the total return an investor can expect if they hold the bond until it matures, which accounts for the market price, coupon rate, and time to maturity. 13. If the market interest rate is higher than a bond's coupon rate, the bond will sell at A. A premium. B. Par value. C. A discount. D. Its face value. Do you know the answer? Correct answer, C. A discount. Explanation. Option C is correct because if a bond's fixed coupon rate is lower than the prevailing interest rates for new bonds in the market, it is less attractive to investors. To compensate for the lower interest payments, the bond's price must fall below its face value, meaning it will sell at a discount. Option A is incorrect because a bond sells at a premium when its coupon rate is higher than the market interest rate. Option B is incorrect because a bond sells at par value when its coupon rate is equal to the market interest rate. Option D is incorrect because a bond sells at its face value, or par value, only when the coupon rate matches the market rate. 14. What does a company's capital structure refer to? A. Its mix of assets and liabilities. B. Its mix of debt and equity financing. C. Its working capital management. D. Its mix of short-term and long-term debt. What do you think is the answer? Correct answer. B. Its mix of debt and equity financing. Explanation. Option B is correct because a company's capital structure is the specific combination of long-term debt and equity it uses to finance its assets and operations. It outlines how the firm is funded by creditors and owners. Option A is incorrect because the mix of all assets and all liabilities is represented on the company's entire balance sheet, which is a broader concept than capital structure. Option C is incorrect because working capital management focuses on short-term assets and liabilities, not the long-term financing mix. Option D is incorrect because the mix of short-term and long-term debt is only one component of the debt side of the capital structure, not the entire structure itself. 15. Which of the following is a non-cash item that impacts a company's income statement? A. Inventory. B. Accounts receivable. C. Depreciation. D. Accounts payable. Can you guess the answer? Correct answer: C. Depreciation. Explanation: Option C is correct because depreciation is an accounting expense that spreads the cost of a long-term asset over its useful life. It reduces a company's reported profit on the income statement, but no actual cash leaves the company for this expense in the current period. Option A is incorrect because inventory is a current asset on the balance sheet, and its purchase or sale directly involves cash flow. Option B is incorrect because accounts receivable represents money owed to the company that will convert to cash, so it is directly related to cash. Option D is incorrect because accounts payable represents money the company owes and will eventually pay with cash, so it is also directly related to cash. 16. How does inflation impact the value of future cash flows? A. It increases the value of future cash flows. B. It has no effect on future cash flows. C. It decreases the value of future cash flows. D. It stabilizes the value of future cash flows. What do you think is the answer? Correct answer: C. It decreases the value of future cash flows. Explanation: Option C is correct because inflation causes a general rise in prices over time. This means that a specific amount of money received in the future will have less purchasing power than the same amount of money has today. Therefore, inflation erodes and decreases the real value of future cash flows. Option A is incorrect because inflation reduces, not increases, the purchasing power of future money. Option B is incorrect because inflation has a direct and significant negative effect on the value of future cash flows. Option D is incorrect because inflation introduces uncertainty and reduces value. It does not stabilize it. 17. What happens to the coupon rate of a bond if the bond is sold at a premium? A. The coupon rate increases. B. The coupon rate decreases. C. The coupon rate remains the same. D. The coupon rate fluctuates. Do you know the answer? Correct answer: C. The coupon rate remains the same. Explanation: Option C is correct because the coupon rate of a bond is fixed at the time of issuance and does not change over the life of the bond. It is the stated annual interest rate based on the bond's face value. Market conditions may cause the bond's price to trade at a premium or discount, but the coupon rate itself is constant. Option A is incorrect because the coupon rate is a fixed percentage and does not increase after issuance. Option B is incorrect because the coupon rate is fixed and does not decrease after issuance. Option D is incorrect because only the bond's market price and its yield to maturity fluctuate. The coupon rate is fixed. 18. What does a firm's degree of operating leverage measure? A. The firm's reliance on debt. B. The firm's sensitivity to changes in sales. C. The firm's ability to generate cash flows. D. The firm's use of equity financing. What do you think is the answer? Correct answer: B. The firm's sensitivity to the changes in sales. Explanation: Option B is correct because the degree of operating leverage measures how a company's operating income changes in response to a percentage change in its sales. A company with high operating leverage has high fixed operating costs, causing a small change in sales to lead to a large change in operating income. Option A is incorrect because a firm's reliance on debt is measured by its degree of financial leverage. Option C is incorrect because the ability to generate cash flows is a general measure of financial health, not what operating leverage specifically measures. Option D is incorrect because the use of equity financing relates to a firm's capital structure, not its operating leverage. 19. Which of the following refers to the measure of risk unique to a particular company or industry? A. Systematic risk. B. Beta. C. Idiosyncratic risk. D. Liquidity risk. Do you know the answer? Correct answer: C. Idiosyncratic risk. Explanation: Option C is correct because idiosyncratic risk, also known as unsystematic or firm-specific risk, is risk that affects only a specific company or industry. Examples include management decisions, labour strikes, or new product outcomes. This type of risk can be reduced through diversification. Option A is incorrect because systematic risk is a market-wide risk that affects all companies, such as recessions or changes in interest rates, and cannot be diversified away. Option B is incorrect because beta is a measure of an asset's systematic risk relative to the overall market. Option D is incorrect because liquidity risk is the risk of not being able to sell an asset quickly at a fair market price. 20. What does a company's operating income return on investment measure? A. The ratio of operating income to total equity. B. The ratio of operating income to total assets. C. The ratio of net income to total assets. D. The ratio of net income to total liabilities. Can you guess the answer? Correct answer: B. The ratio of operating income to total assets. Explanation: Option B is correct because operating income return on investment, or OIROI, measures how efficiently a company uses its total assets to generate profit from its core business operations before accounting for interest and taxes. It is calculated as operating income divided by total assets. Option A is incorrect because the ratio of operating income to total equity is a variation of return on equity, not a standard return on investment measure. Option C is incorrect because the ratio of net income to total assets is the standard formula for return on assets. Option D is incorrect because the ratio of net income to total liabilities is not a standard financial performance metric. 21. What is the impact of a high inventory turnover ratio on a company? A. It indicates strong sales performance. B. It suggests excess inventory levels. C. It may result in lost sales or stockouts. D. It indicates low production costs. What do you think is the answer? Correct answer: C. It may result in lost sales or stockouts. Explanation: Option C is correct because if a company's inventory turnover ratio is excessively high, it can mean that inventory levels are too low to meet customer demand. This can lead to stockouts where products are unavailable, resulting in lost sales and potentially damaging customer relationships. Option A is incorrect because while a high turnover ratio often indicates strong sales, this option does not capture the potential negative consequence of the ratio being too high, which is the focus of the correct answer. Option B is incorrect because excess inventory levels would result in a low inventory turnover ratio, not a high one. Option D is incorrect because inventory turnover is a measure of sales efficiency relative to inventory, not a direct indicator of production costs. 22. Which of the following risks is associated with international trade? A. Credit risk. B. Systematic risk. C. Exchange rate risk. D. Interest rate risk. Can you guess the answer? Correct answer, C. Exchange rate risk. Explanation. Option C is correct because when companies engage in international trade, they deal with different currencies. Exchange rate risk is the risk that fluctuations in the value of one currency against another will negatively impact the profits or costs of a transaction. Option A is incorrect because credit risk, the risk of a counterparty defaulting on payment, exists in both domestic and international trade. Option B is incorrect because systematic risk is a broad market risk that affects all investments, not just those related to international trade. Option D is incorrect because interest rate risk, the risk of changing interest rates affecting asset values, is present in domestic markets as well. 23. What's the key purpose of a tariff? A. To generate government revenue. B. To reduce inflation. C. To protect domestic industries. D. To stabilize exchange rates. What do you think is the answer? Correct answer, C. To protect domestic industries. Explanation. Option C is correct because a tariff is a tax on imported goods. A primary motivation for imposing tariffs is to protect a country's domestic industries from foreign competition by making imported products more expensive, thereby encouraging consumers to buy domestically produced goods. Option A is incorrect because while tariffs do generate revenue for the government, this is often considered a secondary purpose compared to the goal of protecting domestic industries. Option B is incorrect because tariffs typically increase the price of imported goods, which is more likely to be inflationary rather than reduce inflation. Option D is incorrect because tariffs are a tool of trade policy, not monetary policy, and are not primarily used to stabilize exchange rates. 24. What is the primary purpose of capital expenditures? A. To cover operating expenses. B. To invest in short-term assets. C. To invest in long-term assets. D. To pay down debt. Do you know the answer? Correct answer, C. To invest in long-term assets. Explanation. Option C is correct because capital expenditures are funds used by a company to acquire, upgrade, and maintain physical, long-term assets. These are major investments in items like buildings, machinery, equipment, and technology that are expected to benefit the company for more than 1 year. Option A is incorrect because operating expenses are the day-to-day costs of running a business, like salaries and utilities, not long-term investments. Option B is incorrect because investing in short-term assets, like inventory or accounts receivable, falls under working capital management. Option D is incorrect because paying down debt is a financing activity, separate from investing in the company's productive assets. 25. Which financial model is superior in evaluating risk, CAPM is or the Gordon growth model? A. CAPM is B. Gordon growth model. C. Both are equal in evaluating risk. D. Neither considers risk. What do you think is the answer? Correct answer. A. KPM. Explanation. Option A is correct because the capital asset pricing model is specifically designed to determine the required return on an asset by explicitly incorporating its systematic risk, measured by beta. The Gordon growth model focuses on valuing a stock based on its future dividends and does not have a direct, explicit component for market risk. Option B is incorrect because the Gordon growth model's primary focus is on valuation through dividend growth, not risk evaluation in the way CAPM is structured. Option C is incorrect because the models are not equal in evaluating risk. CAPM is designed for this purpose, making it superior. Option D is incorrect because TAPM explicitly and directly considers systematic risk via the beta coefficient. 26. What happens to a company's cost of capital when its credit rating improves? A. It increases. B. It decreases. C. It remains unchanged. D. It fluctuates randomly. What do you think is the answer? Correct answer. B. It decreases. Explanation. Option B is correct because an improved credit rating signals to investors that the company is less risky and more likely to repay its debts. As a result, lenders and investors will demand a lower interest rate on its debt. This lower cost of debt reduces the company's overall weighted average cost of capital. Option A is incorrect because lower risk leads to a lower, not higher cost of capital. Option C is incorrect because a change in credit rating, a key indicator of risk, directly impacts the rates at which a company can borrow. Option D is incorrect because the relationship is predictable and inverse, not random. 27. What is the relationship between a bond's price and its yield to maturity? A. Direct relationship. B. No relationship. C. Inverse relationship. D. Positive relationship. Can you guess the answer? Correct answer. C. Inverse relationship. Explanation. Option C is correct because a bond's market price and its yield to maturity move in opposite directions. When market interest rates rise, the price of existing bonds with lower coupon rates must fall to offer a competitive yield. Thus, a higher YTM corresponds to a lower price. Conversely, when market rates fall, existing bond prices rise. Option A is incorrect because the relationship is inverse, not direct. Option B is incorrect because the price and yield are fundamentally linked. Option D is incorrect because a positive relationship is the same as a direct relationship, which is the opposite of the actual inverse relationship. 28. Which of the following refers to the valuation method based on future cash flows? A. Dividend discount model. B. Comparable multiples. C. Discounted cash flow. D. Replacement cost. Can you guess the answer? Correct answer. C. Discounted cash flow. Explanation. Option C is correct because discounted cash flow is a broad valuation method that estimates the value of an investment based on its expected future cash flows. These future cash flows are discounted back to their present value using a rate that reflects the investment's risk. Option A is incorrect because the dividend discount model is a specific type of DCF analysis that is only applicable to stocks that pay dividends. Option B is incorrect because comparable multiples is a relative valuation method that values a company by comparing it to similar companies using financial ratios like PE. Option D is incorrect because replacement cost is an asset-based valuation method that values a company based on the cost to replace its assets. 29. What happens when a company's projected sales growth exceeds its sustainable growth rate? A. It needs additional funding. B. It generates excess cash. C. It achieves sustainable growth. D. It avoids external funding. Do you know the answer? Correct answer. A. It needs additional funding. Explanation. Option A is correct because the sustainable growth rate is the maximum growth a company can achieve using only its own internal profits while maintaining its current financial policies. If a company plans to grow faster than this rate, its internal funds will be insufficient to support that growth, requiring it to seek additional external funding, such as new debt or equity. Option B is incorrect because growing faster than the sustainable rate creates a financing deficit, not excess cash. Option C is incorrect because the growth is, by definition, not sustainable without a change in financial policy or external funding. Option D is incorrect because the company will likely need, not avoid external funding to finance its ambitious growth. 30. What does the term hedging refer to in managing foreign exchange risk? A. Betting on currency fluctuations. B. Eliminating the risk of exchange rate fluctuations. C. Accepting foreign exchange losses. D. Speculating on currency movements. What do you think is the answer? Correct answer. B. Eliminating the risk of exchange rate fluctuations. Explanation. Option B is correct because hedging is a strategy used to reduce or eliminate the risk of adverse price movements in an asset. In foreign exchange, a company might use financial instruments like forward contracts to lock in an exchange rate for a future transaction, thereby protecting itself from losses due to currency fluctuations. Option A is incorrect because betting on currency fluctuations to make a profit is speculation, not hedging. Option C is incorrect because hedging is a proactive measure to manage risk, whereas simply accepting losses is a passive and undesirable outcome. Option D is incorrect because speculating involves taking on risk in the hope of making a profit from currency movements, which is the opposite of hedging's goal to reduce risk. 31. Which of the following is a primary factor affecting a bond's required yield? A. Debt to equity ratio. B. Collateral backing the bond. C. Dividend payout ratio. D. Operating income. Can you guess the answer? Correct answer. B. Collateral backing the bond. Explanation. Option B is correct because if a bond is secured by specific collateral, it is considered less risky for the investor. The collateral provides a secondary source of repayment if the issuer defaults. This lower risk means investors will require a lower yield on the bond compared to an unsecured bond from the same issuer. Option A is incorrect because while the debt-to-equity ratio affects the company's overall credit risk, collateral is a direct feature of a specific bond that influences its individual risk and yield. Option C is incorrect because the dividend payout ratio is relevant for valuing stocks, not for determining the required yield on a bond. Option D is incorrect because while operating income affects the company's ability to pay and its overall credit risk, collateral is a specific feature of the bond itself that directly mitigates risk for bondholders. 32. What is the main objective of diversification in a portfolio? A. To maximize returns. B. To reduce risk. C. To increase short-term gains. D. To minimize tax liability. Can you guess the answer? Correct answer. B. To reduce risk. Explanation: option B is correct, because diversification involves spreading investments across various assets or securities to reduce the impact of any single asset's poor performance on the overall portfolio. The main objective is to minimize firm-specific or idiosyncratic risk. Option A is incorrect because the primary goal of diversification is risk reduction. While it aims for good returns, it may temper the highest possible returns from a single successful investment in exchange for greater stability. Option C is incorrect because diversification is a long-term strategy focused on risk management, not on achieving short-term gains. Option D is incorrect because while tax implications are a consideration in portfolio management, the primary objective of diversification is risk reduction. 33. Which act mandates the registration of securities with the SEC before they can be sold to the public? A. Sarbanes-Oxley Act. B. Securities Act of 1933. C. Glass-Steagall Act. D. Dodd-Frank Act. Can you guess the answer? Correct answer: B. Securities Act of 1933. Explanation: option B is correct because the Securities Act of 1933, often called the Truth in Securities Law, requires that companies offering new securities to the public must provide investors with complete and truthful financial and other significant information. This is accomplished through the registration of securities with the Securities and Exchange Commission. Option A is incorrect because the Sarbanes-Oxley Act of 2002 was enacted to improve corporate governance and accountability after major accounting scandals. Option C is incorrect because the Glass-Steagall Act of 1933 separated commercial and investment banking activities. Option D is incorrect because the Dodd-Frank Act of 2010 was a broad financial reform package passed in response to the 2008 financial crisis. 34. Which act of 1999 repealed the Glass-Steagall Act of 1933, removing restrictions between investment and commercial banking? A. Gramm-Leach-Bliley Act. B. Sarbanes-Oxley Act. C. Securities Act of 1933. D. Dodd-Frank Act. What do you think is the answer? Correct answer: A. Gramm-Leach-Bliley Act. Explanation: option A is correct because the Gramm-Leach-Bliley Act of 1999 repealed key provisions of the Glass-Steagall Act, thereby removing the legal barriers that had separated commercial banking, investment banking, and insurance services since 1933. Option B is incorrect because the Sarbanes-Oxley Act focused on corporate governance and accounting reform. Option C is incorrect because the Securities Act of 1933 dealt with the issuance of new securities. Option D is incorrect because the Dodd-Frank Act introduced new financial regulations in 2010, including some that re-regulated banking activities. 35. Which of the following refers to the risk that an entire economy or market will be affected rather than just one company? A. Idiosyncratic risk. B. Market risk. C. Credit risk. D. Liquidity risk. What do you think is the answer? Correct answer: B. Market risk. Explanation: option B is correct because market risk, also known as systematic risk, is the risk inherent to the entire market or a market segment. It is caused by broad economic factors like recessions, interest rate changes, and political events, and it affects all investments, making it impossible to eliminate through diversification. Option A is incorrect because idiosyncratic risk is risk that is specific to an individual company or industry and can be diversified away. Option C is incorrect because credit risk is the risk that a borrower will fail to repay a debt. Option D is incorrect because liquidity risk is the risk that an asset cannot be sold quickly without a substantial price concession. 36. What is the risk premium in investing? A. The expected return on government bonds. B. The additional return required for taking on higher risk. C. The return on tax-free bonds. D. The difference between dividend yield and coupon rate. Can you guess the answer? Correct answer: B. The additional return required for taking on higher risk. Explanation: option B is correct because the risk premium is the excess return that an investment is expected to yield over a risk-free rate, such as the return on a government bond. This additional return compensates investors for taking on the higher level of risk associated with that particular investment. Option A is incorrect because the expected return on government bonds is typically used as the benchmark for the risk-free rate, not the premium itself. Option C is incorrect because the return on tax-free bonds is a specific type of investment return, not the definition of a risk premium. Option D is incorrect because the difference between dividend yield and coupon rate is a comparison of returns from two different types of securities, not a risk premium. 37. What is the primary benefit of using a bond's yield to maturity for valuation? A. It represents the bond's annual dividend. B. It accounts for the bond's face value only. C. It reflects the bond's total return over its lifetime. D. It is unaffected by market fluctuations. Can you guess the answer? Correct answer: C. It reflects the bond's total return over its lifetime. Explanation: option C is correct because yield to maturity is a comprehensive measure that reflects the total return an investor can expect if they purchase a bond and hold it until it matures. It accounts for the bond's current market price, par value, coupon interest payments, and time remaining to maturity. Option A is incorrect because bonds pay coupon interest, not dividends, which are associated with stocks. Option B is incorrect because YTM considers not only the face value, but also all future coupon payments and the current market price. Option D is incorrect because YTM is directly influenced by market fluctuations, as changes in market interest rates cause the bond's price to change, which in turn alters its YTM. 38. Which financial document is required to be filed quarterly by publicly traded companies with the SEC? A. 10K, B. 10Q, C. Balance sheet. D. Cash flow statement. Do you know the answer? Correct answer: B. 10Q. Explanation: option B is correct because the Form 10Q is a comprehensive report on a company's performance that must be submitted quarterly to the Securities and Exchange Commission. It provides an unaudited look at the company's financial position and operations. Option A is incorrect because the 10K is the annual report, which is more detailed and filed only once a year. Option C is incorrect because a balance sheet is a financial statement that is included within the 10Q filing, but it is not the filing itself. Option D is incorrect because a cash flow statement is also a financial statement included within the 10Q, not the name of the quarterly filing document. 39. Which key on a financial calculator is used to enter the interest rate for a bond calculation? A. PV, B. IY, C. FV, D. N. What do you think is the answer? Correct answer, B. IY. Explanation, option B is correct because on standard financial calculators, the IY key represents the interest per year, or interest rate per period. It is used to input the market interest rate or yield for time value of money calculations, including bond valuation. Option A is incorrect because PV stands for present value, which is the current worth of a future sum of money. Option C is incorrect because FV stands for future value, which is the value of an asset at a specific date in the future. Option D is incorrect because N stands for the number of compounding periods in the investment's life. 40. What is the relationship between a firm's weighted average cost of capital and its risk? A. Higher risk leads to a lower WACC. B. Higher risk leads to a higher WACC. C. There is no relationship between risk and WACC. D. Lower risk increases WACC. Do you know the answer? Correct answer, B. Higher risk leads to a higher WACC. Explanation. Option B is correct because a company's WACC represents the average return required by its investors. If a company is perceived as being more risky, both its lenders and shareholders will demand a higher rate of return to compensate for that increased risk. This directly results in a higher WACC for the firm. Option A is incorrect because higher risk demands higher compensation, leading to a higher, not lower WACC. Option C is incorrect because there is a direct and fundamental relationship between a firm's risk and its cost of capital. Option D is incorrect because lower risk would lead to a lower required return from investors, thus decreasing the WACC. 41. What's the purpose of the Volcker rule? A. To separate commercial and investment banking. B. To limit speculative trading by banks. C. To prevent foreign currency exchanges. D. To regulate insider trading. Do you know the answer? Correct answer, B. To limit speculative trading by banks. Explanation. Option B is correct because the Volcker Rule, a component of the Dodd-Frank Act, restricts US banks from engaging in certain types of speculative investments that do not directly benefit their customers. Specifically, it limits proprietary trading, where banks trade for their own profit, to reduce the overall risk in the banking system. Option A is incorrect because separating commercial and investment banking was the purpose of the Glass-Steagall Act, which was largely repealed. Option C is incorrect because the Volcker Rule does not prevent foreign currency exchanges, which are a normal part of banking services. Option D is incorrect because insider trading is regulated by other specific SEC rules and securities laws. 42. Which of the following factors affect a company's weighted average cost of capital? A. Dividend payout. B. Treasury yields. C. Current liabilities. D. Asset turnover ratio. What do you think is the answer? Correct answer, B. Treasury yields. Explanation. Option B is correct because Treasury yields are the interest rates on US government bonds and are used as the benchmark for the risk-free rate. The risk-free rate is a fundamental component in calculating both the cost of debt and the cost of equity, which are then used to determine the WACC. Option A is incorrect because while dividend payout policy can influence the cost of equity, it is a company-specific decision, whereas Treasury yields are a market-wide factor that fundamentally anchors the WACC calculation. Option C is incorrect because WACC is calculated using a company's long-term capital structure, not its short-term current liabilities. Option D is incorrect because the asset turnover ratio is an efficiency ratio that measures how well a company uses its assets to generate sales, not a direct input for the cost of capital. 43. What is the primary purpose of using sensitivity analysis in financial forecasting? A. To evaluate different economic conditions. B. To estimate future profits. C. To project optimal investment growth. D. To account for tax changes. Do you know the answer? Correct answer, A. To evaluate different economic conditions. Explanation. Option A is correct because sensitivity analysis is a technique used to determine how different values of an independent variable will impact a particular dependent variable under a given set of assumptions. In finance, this means testing how changes in key variables like sales, costs, or interest rates affect outcomes like profit or NPV, which helps in evaluating performance under different economic conditions. Option B is incorrect because while the analysis may use profit as an output, its purpose is to test the impact of various inputs on that profit, not just estimate it once. Option C is incorrect because sensitivity analysis evaluates risk and uncertainty. It does not project an optimal growth path on its own. Option D is incorrect because accounting for tax changes is just one specific variable that could be tested using sensitivity analysis, not its primary overall purpose. 44. What does the efficient frontier represent in portfolio theory? A. The set of portfolios with the highest return for a given risk level. B. The point where risk is eliminated from a portfolio. C. The portfolio with the maximum expected return. D. The portfolio with the lowest risk and highest return. What do you think is the answer? Correct answer, A. The set of portfolios with the highest return for a given risk level. Explanation. Option A is correct because the efficient frontier is a concept in modern portfolio theory that represents the set of optimal portfolios. For any given level of risk, a portfolio on the efficient frontier offers the highest possible expected return. Conversely, for a given level of expected return, it offers the lowest level of risk. Option B is incorrect because risk, particularly systematic market risk, can never be fully eliminated from a portfolio. Option C is incorrect because the efficient frontier is a curve representing many portfolios, not just the single portfolio with the absolute maximum return, which would also have the maximum risk. Option D is incorrect because there is typically no single portfolio with both the lowest risk and the highest return. These are trade-offs. The efficient frontier illustrates this set of trade-offs. 45. What does the matching principle in accrual accounting require? A. Revenues are recorded when cash is received. B. Expenses are recognised when incurred. C. Revenues are matched with related expenses. D. Expenses are matched with revenues when paid. Can you guess the answer? Correct answer, C. Revenues are matched with related expenses. Explanation. Option C is correct because the matching principle dictates that expenses should be recorded in the same accounting period as the revenues they helped generate. This provides a more accurate picture of a company's profitability for a period by linking costs directly to the income they helped produce. Option A is incorrect because this describes the revenue recognition principle under cash basis accounting, not accrual accounting. Option B is incorrect because while recognizing expenses when incurred is part of accrual accounting, the matching principle specifically links those expenses to the related revenues. Option D is incorrect because this describes cash basis accounting for expenses. Accrual accounting matches expenses to revenues regardless of when cash is paid. 46. Which of the following represents a firm's current liabilities? A. Accounts payable. B. Fixed assets. C. Long-term debt. D. Retained earnings. Do you know the answer? Correct answer, A. Accounts payable. Explanation: Option A is correct because current liabilities are a company's debts or obligations that are due within 1 year. Accounts payable, which is money owed to suppliers for goods or services purchased on credit, is a classic example of a current liability. Option B is incorrect because fixed assets are long-term assets, not liabilities. Option C is incorrect because long-term debt represents obligations due in more than 1 year and is classified as a non-current liability. Option D is incorrect because retained earnings are part of shareholders' equity, representing the cumulative profits kept by the company, not a liability. 47. Which of the following costs is considered a sunk cost in financial decision-making? A. Future production costs. B. Interest on debt. C. Past expenses that cannot be recovered. D. Depreciation expense. Do you know the answer? Correct answer, C. Past expenses that cannot be recovered. Explanation: Option C is correct because a sunk cost is a cost that has already been incurred and cannot be changed or recovered by any future decision. Because these costs are unavoidable, they are irrelevant to future decision-making and should be ignored. Option A is incorrect because future production costs are future, relevant costs that will be incurred based on a decision and are not sunk. Option B is incorrect because interest on debt is a financing cost that may be relevant to future decisions. Option D is incorrect because while depreciation is a non-cash expense related to a past expenditure, the term sunk cost refers more broadly to any past, irrecoverable expense, making option C the best definition. 48. Which of the following describes a secured bond? A. A bond backed by the issuing company's profits. B. A bond with a fixed interest rate. C. A bond backed by specific assets as collateral. D. A bond that can be converted to stock. What do you think is the answer? Correct answer, C. A bond backed by specific assets as a collateral. Explanation: Option C is correct because a secured bond is backed by a pledge of specific assets, known as collateral. If the issuer defaults on its payments, the bondholders have a legal claim to those pledged assets, which makes the bond less risky for the investor. Option A is incorrect because profits are used to pay all obligations, but do not serve as specific collateral for a secured bond. Option B is incorrect because having a fixed interest rate is a feature of most standard bonds, whether secured or unsecured. Option D is incorrect because a bond that can be converted to stock is known as a convertible bond. (49) Which of the following is true about municipal bonds? A. They are issued by the federal government. B. They are taxable at the federal level. C. They are exempt from federal taxes. D. They pay higher interest rates than corporate bonds. What do you think is the answer? Correct answer, C. They are exempt from federal taxes. Explanation. Option C is correct because the primary advantage of municipal bonds is that the interest income they generate is typically exempt from federal income taxes. They may also be exempt from state and local taxes, especially if the investor resides in the issuing state. Option A is incorrect because municipal bonds are issued by state and local governments, not the federal government, which issues treasury bonds. Option B is incorrect because the interest on most municipal bonds is not taxable at the federal level. Option D is incorrect because due to their tax advantages, municipal bonds usually offer lower pre-tax interest rates than corporate bonds of similar risk. 50. What does the degree of financial leverage measure for a company? A. The use of equity to finance operations. B. The firm's reliance on debt. C. The volatility of cash flows. D. The cost of issuing stock. Can you guess the answer? Correct answer, B. The firm's reliance on debt. Explanation. Option B is correct because the degree of financial leverage measures the sensitivity of a company's earnings per share to fluctuations in its operating income as a result of changes in its capital structure. It directly reflects how much a company relies on debt to finance its assets. Option A is incorrect because financial leverage is concerned with the use of debt, not equity. Option C is incorrect because while high financial leverage can lead to more volatile earnings and cash flows, DFL itself is a measure of reliance on debt, not volatility itself. Option D is incorrect because the cost of issuing stock relates to the cost of equity, not the degree of financial leverage. You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.